A high credit score is supposed to save you money, better rates, better approvals, and more financial opportunities. But what if it's actually costing you thousands in hidden ways? Many people with excellent credit fall into subtle traps, from taking on more debt to trusting good interest rates that still add up over time. The system rewards borrowing, not avoiding it, and that can quietly work against you. Today, we will talk about why your high credit score is actually costing you thousands in interest fees. So before we get started, make sure to hit that like button. Also, subscribe to my channel. 10. Sticking to traditional lenders. A high credit score often makes people feel safe sticking with traditional banks. These lenders offer standard rates and loans, assuming you're low risk. But banks and credit cards may not always give you the lowest rates available. For example, a 720-plus credit score may get a decent interest rate, but smaller lenders or credit unions may offer even better deals. What to do? Shop around. Don't just rely on what your bank says. Compare rates from multiple lenders before taking any loan or credit. 9. Overconfidence in automatic approvals. High credit scores can make you complacent. You assume every loan or credit offer is good, but some lenders give automatic approvals with higher interest rates, especially if they know you'll qualify easily. For example, a personal loan pre-approved at 12% interest may seem fine, but alternative lenders may offer 6-7% for the same profile. What to do? Always read the fine print. Don't rely on pre-approved offers without comparing rates. 8. Paying minimum balances on high-limit cards. High credit limits make it easy to carry balances. Even with a high score, if you don't pay full balances, interest fees add up quickly. For example, a $5,000 balance at 18% interest can cost hundreds each month if you only make the minimum payment. What to do? Pay off your balance in full whenever possible, or at least target high-interest debt first. 7. Not negotiating rates because you deserve. High credit scores can create a false sense of security. People assume they already have the best possible rates. But many lenders are willing to negotiate, even with top-tier scores. For example, calling your credit card company and requesting a lower APR can reduce interest fees by hundreds or even thousands per year. What to do? Always ask. Negotiation works, and your credit score gives you leverage. 6. Using credit too aggressively. A high score encourages confidence in borrowing. You might take out multiple lines of credit or larger loans than necessary. While your score allows it, it also increases your exposure to interest fees. For example, carrying multiple credit cards with small balances but high rates can cost more than using one low-interest card. What to do? Borrow only what you need and focus on using low-interest options. 5. Ignoring alternative financing options. High credit scores make people default to traditional financing. But there are alternatives: 0% APR cards, peer-to-peer lending, or promotional loan offers. For example, a 0% introductory credit card can save you hundreds if used responsibly. What to do? Explore all options. Your score opens doors, but you need to choose wisely. 4. Overlooking short-term promotions. High credit scores often make people assume standard rates are best. Promotional offers like balance transfers or special rates are often ignored. For example, transferring a balance from an 18% card to a 6% promotional card could save thousands in interest. What to do? Monitor offers regularly and take advantage of lower rates when possible. 3. Falling into lifestyle inflation. With higher credit limits comes the temptation to spend more. You have access to money. You have a high score. You feel secure. But this often leads to higher balances, longer repayment periods, and more interest fees. For example, upgrading your lifestyle with credit card spending instead of cash savings increases long-term costs, even if your score is perfect. What to do? Stick to your budget. A high score doesn't mean you should borrow more than necessary. 2. Trusting your score instead of your strategy. Many people assume a high score is all they need to minimize costs. But interest fees aren't just about credit score, they're about timing, repayment strategy, and lender selection. For example, Someone with a 780 credit score could still pay thousands in unnecessary interest if they don't plan their payments and choose the wrong lender. What to do? Treat your score as a tool, not a solution. Combine it with smart financial strategies. 1. Ignoring the true cost of interest. The biggest trap of all, thinking that having a high credit score automatically reduces your costs. Interest charges are not magically lower for high scores. They are determined by the choices you make. High credit scores can make you feel safe, but if you carry balances, ignore promotions, or fail to shop around, you are still paying unnecessarily. For example, a $20,000 loan at 10% instead of 5% due to inattention costs you an extra $1,000 per year. That's thousands over time, wasted. What to do? Always calculate the true cost of interest. Don't assume your score alone will save you money. How to stop paying thousands in interest. Here's a clear action plan. Compare rates from multiple lenders, even with a high score. Pay full balances whenever possible. Negotiate lower interest rates. Use alternative financing options and promotional offers. Avoid lifestyle inflation and unnecessary borrowing. Calculate the real cost of interest before taking loans or cards. Track and plan your debt repayment strategically. A high credit score is powerful, but only if you use it wisely. Your credit score is a tool, not a guarantee. It opens doors, but it does not automatically save you money. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.